Hello everyone, welcome to weekly lecture videos. This week our topic is making capital investment decision, and we are covering chapter 9 this week. This chapter expands on the previous chapter by delving more deeply into capital budgeting. We have two main tasks in this chapter. First of all, we will concentrate on the derivation of cash flow estimates, which are the critical input into a net present value analysis, but we largely ignored this in the previous chapter. Our second goal is to learn how to examine NPV estimates critically, and in particular, how to evaluate the sensitivity of NPV estimates to assumptions made about the uncertain future. Okay. So as usual, we have a few learning objectives, and I will be uploading multiple videos covering these learning objectives. So in this video, I'll be mostly talking about the relevant cash flows for a proposed investment. The effect of taking a project is to change the firm overall cash flows today and in the future. So to evaluate a proposed investment, we must consider these changes in the firm's cash flow, then decide whether or not they add value to the firm. Okay, so the first step is to decide which cash flows are relevant for a project decision and which are not. So what is relevant cash flow for a project? The general principle is simple. A relevant cash flow for a project is a change in the firm's overall future cash flow that comes as a consequence of the decision to take that project. Okay, so because the relevant cash flows are defined in terms of changes or increments to the firm's existing cash flows, they are called incremental cash flows. Okay, so the incremental cash flows for a project evaluation consist of any and all changes in the firm's future cash flows that are a direct consequences of taking the project. Okay, so when we are evaluating a project, we will focus only on the changes in the cash flows or increment in the cash flows as a consequence of a decision to take the project. In practice, it would be very cumbersome to actually calculate the future cash flows to the firm with and without a project, especially for a large firm. Fortunately, it is not necessary to do so. Once we identify the effect of undertaking the proposed project on the firm's cash flows, we need to focus only on the project's incremental cash flow. Okay, and the principle that we follow here is called a standalone principle. The standalone principle says that once we have determined the incremental cash flows from undertaking a project, we can view that project as a kind of mini firm with its own future revenues and costs, with its own assets and cash flows. We will then primarily interested in comparing the cash flows from this mini firm to the cost of acquiring that. Okay, an important consequence of these approaches is that we will be evaluating the proposed project purely on its own merits in isolation from any other activities or projects. We are concerned here only with those cash flows that are incremental and result from a project that I already have indicated. Looking back at our general definition, it seems pretty straightforward. Even so, there are a few situations where mistakes are easy to make. Okay, so here we will be learning some common pitfalls and how to avoid them. First of all is sunk costs. Sunk costs, by definition, is a cost we have already paid or have already incurred the liability to pay. The incurrence of such a cost cannot be changed by decision today to accept or reject a project. Okay, so based on our general definition of incremental cash flows, such a cost is clearly not relevant. Okay, so since sunk cost is not a relevant cash flow, we should exclude it from our analysis. Okay, for example, suppose the A2 milk company hires a financial consultant to help evaluate whether a line of infant milk formula should be launched. When the consultant turns in the report, A2 Milk objects to the analysis because the consultant did not include the hefty consulting fee as a cost of the infant formula milk project. Now, who is correct? By now, we know that the consulting fee is a sunk cost because the consulting fee must be paid whether or not the infant milk formula line is actually launched. Okay. The next thing we are going to talk about is opportunity cost. Look, an opportunity cost is slightly different than sunk cost. It requires us, an opportunity cost requires us to give up a benefit. Okay, a common situation arises where a firm already owns some of the asset a proposed project will be using. Okay, for example, we might be thinking of converting an old store we bought years ago for an apartment. Okay, if we undertake this project, there will be no direct cash outflow associated with buying the old building that we already own. Okay, for purpose of evaluating the apartment project, should we then treat this old store free? The answer is no. The building is a valuable resource used by the project. If we did not use it here, we could do something else with that. Okay, and which is why we should consider the cost of this building as an opportunity cost, and that must be considered as a relevant cash flow for the new project. The next point is side effects. Remember that the incremental cash flows for a project include all the changes in the firm's future cash flows. It would not be unusual for a project to have some side or spillover effects, either good or bad. For example, if the Innovative Motors company introduces a new car, some of the sales might come at the expense of its other existing car. Okay, this is called erosion. And the same general problem could occur for any multi-line consumer product producer or seller. In that case, the cash flows from the new line should be adjusted downward to reflect lost profit or lost sales. Okay. In accounting for erosion, it is important to recognize that any sales lost as a result of launching a new product might be lost anyway because of future competition. Erosion is only relevant when sales would not have otherwise been lost. Similarly, there could be positive side effects too. Okay, and to adjust these positive side effects, the cash flows should be adjusted upward, okay, to reflect the additional profit we are having for taking the project. Normally, a project will require that the firm invests in net working capital in addition to non-current assets. For example, a project will generally need some amount of cash on hand to pay any expenses that arise. In addition, a project will need an initial investment in inventories, account receivables. Some of the financing will be in the form of amounts owed to supplier, for example, accounts payable, but the firm will have to supply the balance. Okay, so this balance, that means the difference between the short-term assets requirement and financed by short-term liabilities, the balance is called net working capital. It is easy to overlook an important feature of net working capital in capital budgeting. As a project winds down, inventories are sold, receivables are collected, bills are paid, cash balance are drawn down. So these activities free up the net working capital originally invested. So the firm's investment in project's net working capital closely resembles a loan. The firm supplies net working capital at the beginning and recovers it towards the end. So which means that the change in net working capital or investment in net working capital should be a cash outlay at the beginning of the project, whereas a cash inflow at the end of the project. Financing costs. In analyzing a proposed investment, we will not include interest paid or any other financing costs such as dividends or principal repaid on debt securities, because we are interested in the cash flows generated by the asset of the project. As we mentioned previously in chapter 2, interest paid, for example, is a component of cash flows to creditors, not cash flow from assets. Therefore, cash flows to debt holders or shareholders are not part of our investment decision here. Okay. And last of all, there are a couple of issues. First, we are interested only in measuring cash flows. Moreover, we are interested in measuring it when it actually occurs, not when it accrues in an accounting sense. Okay, so which means that if a revenue is generated this year, but the cash flow actually comes in next year, so it will be the cash flow considered next year, not this year. Okay. Second, we are always interested in after-tax cash flows, since taxes are definitely a cash outflow. So whenever we write incremental cash flows, we mean after-tax incremental cash flows. Okay. However, remember that after-tax cash flows and accounting profit or profit for the periods are entirely different. Okay. So that's the end of our discussion about relevant cash flows. In the next video, we will be talking about pro forma financial statements and project cash flows. Thank you very much.